This episode is brought to you by Tegus, the future of investment research. Look, if you've been reading my newsletters, you know how often I rely on Tegus for my research. I probably read 1 or 2 expert calls a day, probably average 7 a week off of Tegus. They've got the largest transcript library in the world with over 75% of the private market transcripts. Whether you're curious about AI, biotech, or any niche market, Tegus has the insights you need. What sets Tegus apart is its all-in-one platform. It's packed with expert call transcripts, management checks, panel calls, and in-depth financial data. No more jumping between different services or piecing together fragmented data. With Tegus, everything is right at your fingertips. The best part? The insights you get are from the very people shaping the industries you're interested in. You'll find perspective from insiders and executives that you can't get anywhere else. To see Tegus in action and understand why it's one of my go-to resources, visit tegus.com/value. That's tegus.com/value. Trust me, once you try Tegus, you'll never look back. All right. Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could rate, subscribe, review wherever you're watching or listening to it. Today, I'm going to do my monthly ramblings on the markets. Before I get to that, just a quick disclaimer, nothing on this podcast is investing advice. That's always true, but particularly true today because it's just me, one guy alone in the afternoon. Well, I guess my wife and dog are in the background, but just rambling about random things. So I might touch on a bunch of topics. Just remember, none of it's investing advice. I'm just flipping through some things. Please do your own work and consult a financial advisor. Before I get started on this month's monthly ramblings, this is my third one. And I just want to say, I told everyone, hey, if you have any feedback, I'd love to hear it. And the response has been overwhelmingly positive. Now, maybe it's one of those things where, selection bias, if you hate it, you just didn't bother. But, a lot of people came over to YouTube and posted and said, hey, I only listened to these, but I just wanted to do a comment and let you know how much I enjoyed it. Several of you have commented on the beard, the shaving, the lack thereof. One of you has really been tracking the beard on the podcast. I just want to say I really appreciate all the kind words, and the encouragement really, helps me out. It makes me feel good. That's one of the reasons I do these. So let's jump into the things that are on my mind. The first thing I want to talk about, look, I am taping this at July 20th. I just put up a weekend ramblings, weekend thoughts. So, there is some bleed over. You can go read that. I'll include a link in the show notes, but I will just say the Russell is up like 10% in the past 2 weeks. The S&P 500 is down a bit. The NASDAQ's down like 5%. Small cap investors, you can feel it over the past few weeks. They're saying it's here, it's rotation. They're beating their chest. If you look at the S&P 500 over the past year versus small caps, or heaven forbid the NASDAQ or anything, they're still crushing small caps. So, it's kind of like that meme where there's the guy who wins the medal and he sprays champagne and kisses the girl, and then it zooms out and he's like in 8th place. And there are a ton of people above him looking down. But, I posted it because my wife always jokes with me, the only time I'm more miserable than when all of my stocks are going straight down is when all of my stocks are going straight up. And, I find it pretty stressful. I run a reasonably concentrated book. I really like the things I invest in. I'm generally a pretty bullish guy. And I find it a little easier to be zen when, my stocks go from 10 to 9 to 8 and the market's going down. And I just say, hey, I've got a fundamental view. I believe in the value case. I'm investing at 10 and I think fundamental value is 15. I think it's 20. I think it's 25. One of the reasons I love buybacks so much is because when I buy a stock and I know they're out there buying stock back, if the stock goes from 10 to 8 and I think it's worth 20, I kind of say, oh, great, the buyback's going to go a lot farther. It's going to create a lot more value. Now, whether the company will execute it, everybody loves to buy back stock when times are good, but the number of companies you see stop buying back stocks when times are bad, it's pretty crazy and frustrating. But that's one of the reasons I like buybacks, and it's one of the things that like kind of keeps me sane when stocks are going down. But when stocks are going up, when my stock goes from 10 to 12 and I think it's worth 15 or 20, I always say, oh, Andrew, you did so much work on this. You like this so much. It can be really hard because I'm like, why didn't I own more? Why wasn't I more invested? I'm generally a pretty bullish guy. So I find that tough. It's hard enough when it's one company, but when it's all your companies just ripping, it feels tough. I find it mentally stressful. Or, most value investors tend to be invested in a little more defensive stuff. And when markets rip up, which tends to rip up the junkier stuff, or the stuff that you kind of pass on because there was this risk or that risk, or because it had a lot of leverage, those tend to rip up more. So it can be really hard. Markets up 10. Maybe you're up 8, maybe you're up 12, but maybe the things that you were looking up are up 20 or up 30 and you pass on them. So I just find it mentally tough. No real ramblings there, but I just wanted to share that thought. I'll include the full weekend piece. My wife and I took the kiddo to the zoo. That maybe that unplugging is the most helpful thing. But when you do this for a living, it's really hard to unplug on those things. So that's the first thing. Just wanted to ramble on that weekend thought. Second thing, I might do a companion piece to this tomorrow, and if I do, I'll do it in the show notes, a companion piece on the blog. But one of the things that's really interesting me recently is how stock price drives narrative. And everybody knows that, right? Everybody says stock price drives narrative. If your stock is going up and up and up, you're a genius. If your stock is going down and down and down, you're an idiot. And it doesn't matter if if your stock's down 30 and all your peers are down 90, people are still going to criticize you. If your stock's up 50 and all your peers are up 200, generally you still you'll do okay, right? But I was just interested in cross industry. So one thing I was just looking at is if you ask most people right now, they would say Nike is struggling, right? Especially if you ask someone who maybe comes from a more conservative background, they'd be like, oh, they're too woke. The business is falling apart. It's in shambles. The stock is down 23% over the past couple months. And most of that is on the heels of a really bad earnings report they did right at the end of June, right? So most people would say, oh, the stock's in shambles. It's just kind of interesting. If you look at Nike's fundamentals, it's actually hard to say they're in shambles. Yes, they're not kind of growing at the rates Nike's accustomed to, but revenue is kind of going to be flattish, this year, going to be flattish next year. The company trades for a little bit around 20 times price to earnings. I'd have struggle pointing to anything that says the company is just an absolute travesty, right? They still own most of the NFL players, most of basketball players work with them, right? So I have trouble, but because the stock is down, I think it's easy to paint a narrative that the company's in shatters. Compare that to something like Tesla. The stock has just absolutely ripped over the past 3 months. It's up 60% plus. And you'll hear stories about the Tesla turnaround. Now that Elon's got his pay package in place, Tesla's, it's driving, it's full speed ahead. It's got this great turnaround. It's got the story. And I look at that and say, okay, look, the stock's up a lot. There's no question about that. I think some of that might be short covering or other things that are happening there, because if you look, Nike and Tesla are both down quite a bit on a 1 year basis. Despite Tesla being up 60% plus over the past 3 months, it's down about 20% over the past year. Nike's down about 30% over the past year. And Tesla, if you went and looked at earnings estimates, anything, they continue to come down. I'm just looking here. I've pulled up 2026 EPS estimates. At the start of this year, people thought Tesla would earn $7 per share in 2026. That's down to $4.50 right now. And it's actually come down. It went from $7 to about $5 at the start of this year, and it's actually continues to drift down to $4.50. So that's 2026 EPS estimate. So yeah, the stock price is up, but it's hard for me to say look at the fundamentals there and say this company's ripping. They've had to reduce a lot of pricing. I think they're having a lot of troubles. And anyway, I just think it's really interesting. Two businesses that a lot of people have takes on that have somehow become the center of culture wars in some way, shape, or form. And one stock is ripping, one stock is kind of stalled out or dropping. But if you looked at the fundamentals, it'd be hard for me to tell which was which and why. So I just think the stock price driving narrative. Okay. Speaking of companies that can be at the center of the cultural world, one thing I've been researching, there have been a couple companies recently where they've had a CEO change. And I'm really interested in what I call the CEO was an idiot, but the CEO was removed companies, right? And I'm interested in them in two ways, because if I told you that the company was getting run by a monkey and the monkey is getting replaced with a actual living, breathing human, you might say, oh, great, that's a long, right? It's going to be an improvement. And I don't know, the classic story here would be Steve Ballmer at Microsoft. I mean, every terrible decision they could make, Microsoft was making under Steve Ballmer. They replaced him, and now the stock is, on this incredible run. They're doing great. They're taking over the world. And that's one example. But I also hear horror stories of, hey, the CEO was terrible. There was a proxy fight to replace him. The new guys come in, they hire this really incentivized management team. Everybody thinks they got great assets. And then they come in and the internal business is just an absolute shambles. It's an absolute horror story. And, the stock has gone from 10 to 5 under the prior management. New management comes in and all of a sudden they say, oh my God, this is a disaster. And, 2 years later, the stock's in the pennies or it's a disaster. And I've seen both happen, and I don't know how to identify one or the other. Like I wish there was a trick. I really don't know, but I've looked at a lot of these companies where the CEO has been replaced recently, and from the outside, it's really hard to tell which is going to be which. And I will be honest, like you really don't know. It's not until probably 9 or 12 months later that you really start seeing the results and the stock starts going up or down, or you start realizing, oh my God, this turnaround isn't going to turn, or this is a turnaround that I didn't realize even needed to turn. I just thought it was a poorly managed company. And I don't know, but it's one thing that's been on my mind. And increasingly, as we're seeing a lot of CEO turnovers across the board, I don't know how to diligence that or how to kind of express that risk, but it's something I've been looking at and thinking about a lot. Speaking of diligence, another thing that's been on my mind recently is diligencing ideas that you don't like. I wrote something the other month about how much I love energy drinks and how if I miss another energy drink stock that goes to the moon, I'm just going to have to, I don't know, flog myself or something. But one of the best pitches on the podcast and that I've read this year was I had Devin on to talk about Hate, which is a distributor of nicotine pouches, the dominant distributor in Europe. They're an upstart in the US. I think the company is really interesting. I have some really, really smart friends who are long it. And I just find the company really difficult to underwrite, focus on, think about. And I think one of the reasons I find it so difficult is because I don't use nicotine. I've never used nicotine or tobacco. I have no plans to. And that's no judgment on people who do or who do. That's completely fine with me. You're your own person. You can do whatever you want. But because I've never used it, I have trouble like thinking about it, building the mode out of my head. And maybe that's a failure of imagination on my point, but I don't know. I've talked to friends who have used Hape's product, or Nico Kick is their online site in the US. They've generally spoken pretty highly of it, but it's just difficult when you're not the target demographic to diligence some of these things. And why am I saying this? The two places that I think are really interesting that I know a lot of investors spend a lot of time looking at and thinking of are dating products and video games. And every time I hear someone pitch it, I wonder if they are able to diligence it. So let me dating products. A lot of investors are looking at Match right now. Match, for those who don't know, owns Match.com. They own Tinder. They own Hinge. Those are three of the biggest dating sites out there. Starboard got involved with it recently, and if you read their deck, they basically say, "Hey, you're the dominant dating company, and you're trading pretty cheaply. We want you to buy back shares and maybe go private if you can't figure this out." But they don't really have huge operational improvements. But Match is interesting because the people who call me up who want to go long it, who are interested in it, I'll ask and I'll be like, "Hey, how are you looking at the product?" And they'll say, "Oh, I've read some calls or I've seen some things about people dating online." And I just think it's dangerous. Like if you're looking at a dating product and you're not using that product, it's kind of dating. A long time ago, when my wife and I were just starting to date, we'd been dating like 6 months. I was looking at the owner of JDate. And I remember I told my wife, I was like, "Hey, I've got to download JDate and see like how the product looks and feels." And that was received that had mixed signals and mixed reception. But, you've got to download the product and at least look at it. And a lot of the people I talk to, most investors are not in their 20s anymore. They're in their 30s, they're in their 40s, they're in their 50s. They're married, they have kids, they're in serious relationships. They're older than the target demographic for the most part of a dating product. And a lot of them especially met their wives in person, IRL, as the kids would say. And if you never used a dating app, or if you haven't used a dating app in 5 or 7 years, I think it's really tough to understand the dating product market. So, you can read the 10K, you can hear how the company talks about it, but unless you're actively using the product and out there kind of seeing how it works and seeing what the trends are, it's tough for me to say that you are the right person to go buy a dating product. I don't know if I'm thinking about that correctly or incorrectly, because, if I'm not flying to the moon, if I'm not flying defense jet fighters, am I the right person to buy Lockheed Martin or look at a defense contractor? Well, I would say, yeah, you can't be a fighter jet pilot and buy Lockheed Martin, but it does feel like Lockheed Martin them have a lot more lock-in than something like a dating product. So anyway, that's one that I thought about. The other I thought about is video games. I know a lot of investors love video game companies. Nintendo is a ever popular pitch among value investors. EA, Take-Two has a fantastic CEO. That's been a huge pitch. And I hear that there's, I think you buy a video game for $60 and you might spend 500 hours inside the video game world. Like there's probably a lot of pricing power there. And the company has gotten increasingly good at this, micro monetization and subscriptions and all that. I get it. I get it. But I do wonder if you are not playing video games actively, if you're really the person to buy a video game product. And again, maybe this is the fighter jet product, but let me give you one example. Square Enix, which owns Final Fantasy, and Final Fantasy was my favorite video game growing up, but they have Final Fantasy Online. And I know a lot of people who pitch Square Enix, and when they talk, like they say, hey, Final Fantasy Online is worth the whole company. I'll say, okay, cool. Like, how do you track engagement? And they'll say, oh, well, we look at all these statistics and stuff. And I don't know, like if I feel like if you were an active Final Fantasy player, you would be able to tell if Final Fantasy Online was having an inflection up or down to the negative way before you could kind of see it if you were just following some statistics or something. I feel like wrestling, to give an example, I would hear from wrestling fans, hey, the product's getting kind of stale. Hey, AEW is really making inroads. And you would see that like 6 months before kind of the financial analysts would really pick up on it. So again, I don't know, but diligencing products that you're not into, investing in companies that maybe the product isn't for you, it's just something on my mind I've been thinking about a lot. All right, we're running along. There are two more things I want to talk about. Speaking of diligence, alt data. Every time you buy, especially a consumer-focused company these days, you will, if you talk about it with another investor, they will say, hey, what's the alt data look like? What's the quarter look like? All this sort of stuff. Hey, I'm looking at buying retailer X, and they'll say, ooh, retailer X, I've got credit card data that says this quarter is going to be bad. Maybe you want to wait till the quarter comes, all this sort of stuff. And look, that's great. Knowing how the quarters look and thinking about that. And, if the stock's at 10 and you really like it, but the quarter is going to miss and the stock's going to be at 8, you could buy, 20% more of it if you can wait for the miss. Nobody wants to take a 20% drawdown. But I do wonder, are there edge cases where the alt data is telling you something wrong and there's ways to take advantage of that? Because, alt data is getting so heavily used in quant models, things that I think are a little more unthinking, maybe not unthinking, but more rigid and rules-based. And I wonder if there are places where alt data is kind of failing and it's got potential for a thoughtful value investor, someone who's really going to dig into it and think through it to do a lot of work and generate alpha. So I'll just give one example. Say you've got a company and, it becomes clear from the alt data that analysts are estimating that sales are going to drop 5%, and it becomes clear from the alt data that no, sales are going to be down 10%. Obviously, that's pretty bad. Obviously, I say obviously in quotes, that's probably pretty bad, and the stock will probably drop on that quarter. But if every peer is seeing their sales go down 30% in that quarter, that company is taking enormous share. And I wonder if there's proof that the alt data is actually showing, hey, yes, the industry is really soft, but this company has discovered a better mousetrap, right? They are taking tons and tons of share. And if and when things flip, the company, whatever, is going to be a rocket ship because they're taking so much share. I don't know. I don't have any firm examples of that, but that's just another thing I've thought of. It's just one example I've thought of where, hey, everybody's so focused on this quarterly, this monthly, this very short-term alt data. And, I tend to take a longer term focus. I tend to look more at the fundamentals, not be trading on quarters. And I've just been thinking of what are ways that individual investors with a longer term focus can actually, take the strength of alt data and turn it into a weakness or use it against it. And that's one case. Okay. Last thing I want to talk about, idea dinners. I co-hosted a really nice one last month. We had an absolutely awesome time. Idea dinners can be kind of hit or miss, but if you get the right group of people going, it's really fun. It can be really informative. It can be refreshing. The idea exchange, there is something different about having a group of, 4 people come together and ask different questions and bring different angles about it. And again, you need the right people and kind of the right mixes and stuff, but it can be a lot of fun. It can be a lot of really refreshing. And I find if you've got the right group and you talk to the right people, you come to work a little bit more energized and refreshed the next day and just wanting to be a little bit better investor. So I'm always looking for ways. I've mentioned a few times. I think we're going to do a yet another value podcast event in person at some point in the future. Hopefully, I'll be able to talk to that more next month. But always looking for new idea dinner types things. So if anybody's got ideas, I don't know if I can host too many on the regular, or if I can commit to too many. But always looking for stuff like that. So if anybody's got networking ideas that they found have like kind of energized them as an investor or anything, I'm open to them, whether pitching in to kind of help organize or just showing up and eating some appetizers and chatting. But just mentioning, I think investing it's very easy, particularly for value investors, to fall into, hey, I've certainly done this myself. Hey, all I do is read 10Ks and earnings calls, and all I do is I'm a bookworm for 10 to 14 hours a day, and that's it. And maybe that worked. I think Walter Schloss famously, that's kind of what he did, dark room, no windows, just went and read, and he'd buy companies under book value. Maybe that works. I don't know if that works as well in modern markets, where I think computers have probably picked over most of the really easy quantitative stuff. I think it's really helpful to go kind of talk to other people, make new connections, both connections in terms of people and connections in terms of mental connections of, I never thought of applying an industrial lens to this retailer, but maybe that, or that type of thing. So anyway, this has been probably my most rambling of the monthly ramblings. I appreciate everyone listening. It is July. I look forward to seeing you guys kind of sometime mid-August as we wrap through summer with some more ramblings, and I'll try to maybe be a little bit more focused because I feel like I was really rambling on this one, but appreciate everyone listening and looking forward to that. This episode is brought to you by Tegus, the future of investment research. If you follow my newsletters, you know that Tegus is one of the things I use most often. Almost every post I have has some clip from an expert call or some quote from a management transcript that I've got off BMSEC that, it's because of Tegus that I've got access to all of that. It's revolutionized how I get up to speed on new industries and companies. I've been a happy subscriber of it for over 3 years now. And I tell you, I use probably every day I'm logging on to Tegus to look at an expert call transcript. And I certainly know, my BMSEC, I'm glad that it's unlimited because I am looking at BMSEC all the time. I'm looking at my Google Chrome right now, and I have 30 tabs open, and I'd say 18 of them are from BMSEC. So between Tegus and BMSEC, I am a very devoted user here. Look, it's one platform where you can dive into expert call transcripts, management checks, panel calls, and detailed financial data. No more fragmented data sources or endless searching. Tegus brings everything together, giving you a crystal clear view of the industries and companies that matter most. If you're ready to supercharge your research, visit tegus.com/value. That's TEGUS.com/value. Trust me, once you've experienced Tegus, you won't go back to your old way of doing research. A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.